All right, good
Right.
afternoon, and welcome to the 11th and final edition of the Managerial Insight Series. This series is a partnership between executive education at the Darla Moore School of Business and Mike Switzer and the South Carolina Business Review. My name is Mark Cicchini. I am the Associate Dean for Executive Education at the Darla Moore School of Business. I'm still getting used to that. This is my sixth day on the job. Uh, Today, we're going to be hearing from Joey von Nessen. So Joey is the chief economist at the Darla Moore School of Business. Joey's going to be giving us an update on the state of the South Carolina economy. I remember Joey and Doug's last performance was back in December that I saw, and that was it seems like such an innocent time now. It was the Economic Outlook Conference for 2020, and the only thing I totally remember for that was there was this okay, we've been in this long-term expansion. We're cautiously optimistic about the future, but if anything goes wrong, things could go really bad. So something went wrong. So
But
we all know that.
but he
So
says that that's his caveat every year.
that's what he does all the time.
Yes.
So just real quick before Joey gets started, we'll be recording this session and we're going to make it available after the close of the session. We have to put closed captioning on it, so it might take a couple days, but this session will be available to the public through the executive education website. We are also going to be sending slides out from Joey's presentation as well. There's a Q&A session after the talk, and so anytime during the talk, if you have any questions, you can ask them through the chat function, and Mike Switzer will be running that portion of the discussion a little later. So now I will turn off my mic and let Joey have the floor.
All right, well, thank you, Mark, and good afternoon, everyone. Thank you again for the opportunity to be with you today and to participate this afternoon. And yes, we are in a whole new world, certainly compared to where we were last December. Mark mentioned, something unusual that happens, and that is something we refer to as a black swan event, something totally unpredictable that really comes out of nowhere, and that certainly has been the case in 2020. So once again, my name is Joey von Nessen. I'm a research economist in the Darla Moore School of Business. And in our division of research, we practice what I like to call so what economics. And I always use that term half jokingly, but to make a serious point, which is that we always look at the economic data and are asking the question, so what? How do these data apply? How do they help businesses and other organizations to make strategic decisions? And anytime you are looking to make a strategic decision, as a business or an organization, of course, you first have to understand the market landscape and the economic environment in which you find yourself. And so what I want to do over the next few minutes today is to provide some perspective on what the economic landscape looks like here at the beginning of July 2020, what's happened in South Carolina as a result of this pandemic, and some of the things that we need to be thinking about and looking for in terms of assessing of how we can assess what the recovery process will likely look like in the second half of 2020. And so to start off, to really begin thinking about that, I think the first thing is perspective. We really need some perspective to get a handle on what we're seeing right now with this current recession. And the best way to do that is to just consider how different this current recession has been from previous recessions that we've seen in the United States, at least over the last 30 years or so. And I like to call what we're in now the Great Shutdown, and compare that to what we called the previous recession in 2008, of course, which was the Great Recession. And that's a very, I think, accurate way to compare the two, because this current recession is really the first time that we've had a strong and healthy economy, which we did have up until early 2020, but a strong economy that was intentionally shut down by our government as a response to a pandemic. So an external factor that really came in and shut down an otherwise healthy economy. We really haven't seen that before. And that makes this recession very different from those that have come previously. We see that in two specific ways. Number one, this recession has been far more intense than previous recessions, but it's likely to be far shorter in overall duration as well, particularly when we compare it to the recession from 2008, the Great Recession. And we can see this very clearly in the data. Specifically, we can look at initial unemployment insurance claims to get a feel for this comparison. Now, initial unemployment insurance claims is a good measure of the number of newly laid off people in South Carolina. And so we can measure that on a week-to-week basis. And just look at these two lines here. The red line represents the current pandemic that we're going through, the current recession, and the y-axis there represents the number of unemployment insurance claims above and beyond the level that they were at before the recession began. So you can see that the red line denotes that we got about to a level in April of about 60,000 initial claims per week being filed in South Carolina, 60,000 more than we saw back in February before the pandemic began. And that just completely dwarfs anything that we saw in 2008 during the Great Recession, when we peaked at about 10,000 claims per week above and beyond what we were seeing as the norm before the financial crash in 2008. So far more intense. But also, when you compare the length, notice that it took about a year and a half, about 80 weeks, for us to get back down to pre-recession levels of initial unemployment insurance claims following the 2008 financial crash. And notice how that's very different from what we're observing now, where we've already come way down off of that initial round of layoffs in the current pandemic. So far more intense in terms of the overall intensity of the recession, far more intense in general, but likely to be shorter in overall duration. And of course, this is a worldwide pandemic. This is not confined to South Carolina by any means, and we can see this very clearly when we look at GDP growth for the United States. You can see negative 5% growth in the first quarter, coming off of many consecutive quarters of positive growth. So as I mentioned before, the US economy was actually in pretty good shape going into 2020. And that is a really good news, because as we move ahead, it suggests that we might be able to get back to a level of economic activity that we consider more normal faster than we would have if there were some underlying structural problems with the economy itself that had really been driving or the causal factor behind this recession. But that, again, is not the case this time around. Now, other data we can look at to show what has happened specifically in South Carolina. If we look at employment growth trends overall, we can get a snapshot of what's been happening from an industry level perspective. And this graph is really the bleakest graph, for lack of a better term, that I'm going to show you today, just in terms of outlining what South Carolina looked like, what the job losses looked like, really during the heart of the shutdown period. So during April and then early May, before the rebound and the reopening really began to get going. So you can see the major industry sectors in South Carolina here, what the job numbers look like. Now, the big three in terms of where we saw the most losses were in leisure and hospitality. That was number one. Number two, manufacturing. And then number three was healthcare services. And I can outline here on the graph some arrows, so when you can see the major sectors that were affected. I didn't put an arrow on leisure and hospitality just because that's fairly obvious in terms of the large negative bars there. But manufacturing was number two. It doesn't look like it, but part of manufacturing is actually tied into the professional and business services sector, simply because manufacturing relies a lot on contingent labor. And so we have to pull the contingent labor, which is classified in professional and business services, out in order to really capture the impact on manufacturing. But in reality, manufacturing was number two. Health services was number three, non-essential healthcare services. And then you can see other services was affected significantly as well. And these numbers really do show what you think they show. So for example, if we look at leisure and hospitality, that really does, that 33.6% really does mean that we saw a decline in total employment in the leisure and hospitality industry of 33.6% when comparing May of 2020 to May of 2019. So these are some significant numbers here that we're talking about. If we look regionally in South Carolina, we can get a sense of which areas of the state have been most impacted over the last several months. And the dark green counties represent those that have been most affected. But this follows very logically from the industries that have been primarily affected, mainly leisure and hospitality and manufacturing. And if I were to show you a state map that really evolved, or that progressed from March to April to May to June and into July, what you would notice is that the counties affected first and earliest were those along the coastal regions of the state, on the eastern part of the state. And then it really migrated towards the west and towards the upstate as we moved into April, May, and June. And the reason is simply because leisure and hospitality, that is the industry that is the most concentrated within coastal South Carolina, so Charleston, Myrtle Beach, and Hilton Head. And of course, leisure and hospitality means in-person services, and as a result, social distancing measures that are going to apply most strongly to them. So those are the ones that are first affected. As we began to see consumer demand taper off, then we saw that impact manufacturing more, particularly when we also started to see supply chain disruptions come into play. And so the upstate began to feel it more as well as we moved in, as I mentioned, to April and May and June. And overall, we can see the biggest areas of South Carolina that have been affected as a whole being the upstate and Charleston. One other important point when we think about the geography in terms of which areas of South Carolina have been most affected, notice that the only major metropolitan region of the state that is in light green here is actually Columbia, actually the Midlands region. And that's because we don't have in the Midlands as much of a concentration in leisure and hospitality or in manufacturing. So we have in some sense been spared so far. However, it's important not to be complacent with respect to that, because as we move ahead into 2021 especially, we have to recognize that Columbia also is more vulnerable to tax revenue losses and budget cuts because a bigger share of its economy is in the public sector, in the public domain. So just because the Midlands region has been somewhat spared so far relative to other major metropolitan regions of the state, that doesn't necessarily bode well for the recovery process in terms of Columbia leading the pack going into 2021. So an important caveat there. So that gives us a sense of where we've been over the last several months and which industries have been hardest hit, which areas of South Carolina have been hardest hit. And as we move into July, of course, we now want to begin thinking about what the path to recovery actually looks like. Where are we headed in the second half of the year? And here, as the slide suggests, I would say to you that there is some good news. Again, the data that we've looked at so far look overall pretty bleak, especially when we're looking at the unemployment rate of 12.5%, and we look at some of those employment data themselves. But as we begin to think about looking ahead, there are some reasons we can be somewhat optimistic. The first is that if we look at the unemployment rates themselves, you'll see a major directional shift beginning in April of 2020, going into May. So this chart here shows us the unemployment rates going back to February, both for the United States and for South Carolina as a whole. And you see the current unemployment rates in May and June. So we don't have the June rate for South Carolina yet. So we are looking at 12.5% in South Carolina as of where we stand today for the most recent data. But basically, even though the unemployment rates are very high right now, we have seen a directional shift. So as we moved into May and into June, we've seen the economy reopen as people have been going back to work. And we've actually seen some significant job creation in the last 2 months. So it's not the unemployment rates themselves that are important when we're looking here at this graph, but rather the directional shift that we've seen in recent months, and that people are beginning to go back to work, and that many of the layoffs that occurred were in fact temporary, and we're seeing people move back into the labor force and go back to work as we move ahead. And where are the biggest gains? Where have we actually seen these jobs being created when we look across the US as a whole? Well, it turns out that the two biggest industries that have seen job gains are restaurants. So these are sub-industries, smaller when we break it down. Restaurants is number one, which is something that you might expect, but dentist offices are actually number two, which is a bit unusual, something that you may not have expected to see here. But this is actually a reflection of what the healthcare industry more generally has seen, which is that all of the non-essential healthcare services were essentially shut down as well back in April. So that's everything from physical therapist's office to dentist's office to any type of non-emergency care or non-emergency surgeries. And so as those offices began to open back up, it turns out that dentists were actually the biggest gain, or represented the biggest gain in terms of the number of jobs for healthcare, and number two overall. So very much in line with what we would expect, although you don't necessarily anticipate dentist's office being really in the top three there in terms of where we've seen gains in the last couple of months. Now, that was national data looking at those two industries. But if we look more generally in South Carolina, we can see that the total job losses came close to about 260,000 between March and April of this year. And we can see the job gains between April and May, about 75,000, which means that we've recovered about close to 30% of the jobs that we lost between March and April, about 30%. And that's a really good start as we move into the summer. And to really put that into perspective, that 30% in perspective, keep in mind that following the Great Recession, it took us about 5 years in South Carolina to recover all of the jobs that we lost during 2008 and early 2009, about 5 years. And we've already recovered about 30% of the job losses in just 2 months in South Carolina in this current recovery. So I mentioned before that this current recession is far more intense, but likely to be shorter in duration. That's one of the reasons why, just looking at the employment gains that we've seen and comparing them to what we saw back in the aftermath of the 2008 financial crisis. One other area we can also look at in terms of where we stand right now and where we see things going moving forward is to look at unemployment insurance claims once again. And we always talk about, from a health perspective, flattening the curve, right? So that's become a part of the jargon of everyday life now, and the importance of flattening the curve. But I would suggest that there's a parallel to that in economics. Where do we want to flatten the curve in economics? This would be it. It's really, really important that we flatten the curve in terms of initial claims, or flatten and bend the curve for initial claims and for continued claims. And so these two graphs on the left, the initial claims, as we talked about before, represent the newly unemployed people in South Carolina, the number of newly unemployed people. The continued claims represent the total number of unemployed people in South Carolina. And it doesn't represent everybody, but initial unemployment insurance claims and continued claims data give us a good metric for looking at the directional shift and the patterns of employment in South Carolina, which direction that we're moving in. And notice that we really peaked for both of these in April, late April, early May, and they've been coming down fairly steadily since then, which is, again, great news as we're moving ahead. But in addition to that, keep in mind we're in early July right now. Also notice that in the last couple of weeks, as we've seen a spike in the number of new cases, that the rate of decline in both graphs in terms of the initial claims and continued claims has tapered off a bit. So it's not nearly as steep as it was. So it's going to be very important to keep our eye on these unemployment insurance claims data as we move ahead to see how the number of new cases end up impacting the employment recovery that we've seen so far, which, as I mentioned, up through June had actually been pretty strong. Now, let's turn the tables a little bit more then and look further ahead. We've talked about the last several months. We've talked about where we are in July of 2020. Now let's talk about the second half of the year and where we anticipate things going, and specifically what metrics and what analytics we need to be doing and considering to get a good assessment of what the pace of recovery is likely going to be in the second half of 2020. What does economic recovery really look like? And to get a handle on this, I think the first thing to recognize is that when we look at all of the metrics across the board, when we look at all the different data that we see in the news every day, fundamentally, all of those data and metrics have to be filtered through these two specific parameters, the medical community and the consumer, because the economic recovery is ultimately going to be driven by these two variables. And every other metric that we look at is going to be filtered through these two and are going to be impacted primarily by these two factors. So what do we mean by the medical community? Well, this simply means both the number of new cases that we see, the data that is reported in terms of cases, in terms of illnesses, in terms of the death rate, all of those different things matter. And also how public policy changes and guidelines change from the medical community based on those data. How does that change public policy and the guidelines that we see coming out? Secondly, the consumer. How does the consumer respond to the medical community? What does consumer demand actually look like? Because consumers are either going to be fairly fearful and concerned about going out into public for their safety, or they're not. And of course, that's going to be on a sliding scale in terms of what that looks like. But consumer safety and consumer fear, how the consumer feels, what their confidence level is, is of course going to drive ultimately consumer demand, which is what's going to propel this recovery. So both of these are intertwined. They're clearly not independent, but every other factor that we look at, every other variable, every other metric, we need to think back to say, well, how does this result from or would be influenced by changes in what we're seeing coming out of the medical community, and how has it changed based on how consumer demand is affected or how it's changing. So those are the two factors that ultimately we need to be watching. But as we look ahead, again, several factors that we can consider. We're trying to create a roadmap here. What can we anticipate during the second half of the year? And there are a couple of ways I think that we can really begin to think about this in terms of what the pace will look like, and then several factors that will influence it. And I like to use a diagram just to simplify it in order to really show different possible paths to recovery, recognizing that we can move back and forth on different paths at any given time. So this flow chart or this diagram or decision tree can be helpful to begin thinking about three likely outcomes that we may see in the second half of 2020. And we see a positive, a more of a neutral, yellow, and more of a negative in red there. And just to play this out, if we look at the decision tree, look at the first decision point here in terms of evaluating where we're going. So the first decision point is simply, is a treatment going to be available in 2020? And the answer is either yes or no. And if the answer is yes, then we're clearly on the top side here of the decision tree. And the question then becomes, well, is it going to be available sooner or later? So in the summer or sometime closer to the end of the year. And of course, if the answer is sooner, if we do see a treatment available sometime this summer in the late summer, then we're very likely to see the continue to see the very substantial employment gains that we have seen in the early part of this of the summer. That is, going back to the fact that we recovered about 30% of the jobs that we lost already, that significant increase is likely to continue, which economists tend to call a V-shaped recovery pattern. So that's really the best case scenario. And based on the data that we have right now, a treatment being available this summer or perhaps in the early fall, not very likely. So of course the green scenario is very, very unlikely to occur. What's more likely is this yellow box where we see a treatment that's either available late in 2020 or in 2021 sometime, so not at all this year. And in this case, we can anticipate a U-shaped recovery, which is a slow and steady recovery in the second half of 2020 that continues to gain momentum in 2021 if we see an acceptable number of new cases. And I put acceptable there in quotes because, of course, that's a very vague term. But when I say acceptable, I mean acceptable from the perspective of the consumer, acceptable from the perspective of businesses, and from policymakers. And of course, all three of those groups are working together. Again, that's not independent. But coming back to the idea that consumers have to feel safe going out. And when we see a spike in cases, that's either going to make them less confident or it's not. It's going to depend on region. It's going to depend on where we're seeing the spike in cases. All of those things matter. And then for businesses, to what extent does an increase in cases affect their processes? Do they have to shut down because they see their local political leaders enforcing some new guidelines or not? What does that environment look like? So all three of those pieces matter. But if we're in a position where in general, we don't see a major pullback and we do see, again, the consumer and businesses and policymakers reacting in a way that they are less fearful and they want to continue to be going out and to resuming their normal everyday activities, then a slow and steady recovery process is likely to continue as we move through the second half of the year. And then, of course, the final scenario in red, where we see a new major outbreak, which we haven't seen yet. We've seen an increase in cases, but if we do see a new major outbreak in the second half of the year as we get into the fall, of course, that could create a W-shaped recovery, which a colleague of mine calls W is for wobbly, which is where we see recovery, then we see retraction, then recovery, retraction, and we see a lot of back and forth. And of course, that creates more uncertainty and is the worst case scenario that we hopefully don't find ourselves in. So then as we move ahead, if yellow is the most likely case, if that U-shaped recovery is the most likely case that we're going to see moving forward, what do we mean by slow and steady? And what are the factors that are going to drive whether or not we see a steeper recovery, a faster recovery, or a slower one? So look at this graph here just to illustrate the point. So we saw a major decline, that red line there between March and April. We've seen about a 30% recovery so far in the number of jobs. You can see where we are with the yellow star there. And so the question is, what's going to influence whether we hit the light red, the light blue dashed line or the dark blue dashed line? So given that we're going to see slow and steady and we're not going to maintain the pace that we've seen so far, are we going to get close, or are we really going to fall away? And is it going to be a bit more of a struggle in the second half of the year? Well, I would suggest that there are several factors that we want to watch. And specifically, I think August is a possible month of reckoning, what I'm calling a month of reckoning. And I'll talk about why that's the case. But there are a couple of different factors that I think we need to be on the lookout for to assess whether we're going to see a faster versus a slower recovery pace in the second half of the year. First of all, it's important to look at bankruptcy rates. I think if there's one statistic that you're going to look at to assess what the pace of recovery is likely to be, bankruptcy rates would be it, because that's going to give us indication of whether or not businesses are seeing a level of demand that is sufficient for them to be able to continue to operate, or whether they're going to begin to fall away and generate additional layoffs and all the ripple effects that go along with that. Are businesses stabilizing, or are they not? And that's especially critical now, because if we look at the PPP dollars, the Payroll Protection Program, and the businesses that have captured some of those dollars, if we look back to when the PPP program first went into place and when businesses began capturing some of that money to help sustain themselves during the shutdown, many of those dollars are now exhausted. So the firms that were the earliest receivers of those dollars are now getting to the point where they've exhausted their dollars. And so they're now having to either sustain themselves on market demand alone, or they're beginning to have to lay off workers that perhaps they would not have had to do so, or not have to do so far. And so as we see more and more businesses exhaust the use of their PPP dollars, we're really going to get a feel for whether they're able to sustain themselves based on market demand. And again, the best statistic for assessing that, how successful they are being in general, is going to be bankruptcy rates. So a very crucial statistic to look at during the second half of the year to gauge the pace of this recovery and what it's likely to be in the coming months. In addition to that, of course, the spike in COVID cases, which will affect underlying, or could potentially affect underlying demand, also is going to influence bankruptcy rates in terms of affecting business activity overall. But again, bankruptcy rates are a good way to see what the net effect is on the economy overall. The social hangover effect, another factor that's important. This goes back to consumer fear. I like to use social hangover effect as a shorthand for that. But basically, how do consumers respond? Are they comfortable going out in public even with a higher case rate, or are they not? How is that going to play out in July and August going forward? A second factor, in addition to the bankruptcy rates that I think is critically important to watch, is federal unemployment insurance supplements, which are currently set to expire, as you see here, on July 31st. So in South Carolina, if you are unemployed, if you file for unemployment, you can get up to $326 per week in unemployment insurance. But right now, the federal supplement gives you an additional $600 per week. So that gets you over $900 per week in unemployment insurance, which is actually higher than the average weekly wage in South Carolina across all industries. So there are many workers that are currently earning more on unemployment right now than they would be at their job. And of course, that's creating an incentive perhaps to postpone, in some cases, going back to work. So when that expires on July 31st, assuming that it does, and we don't see any extensions that are put in place by Congress, then that's going to, on the margin, provide more incentive for people to go back to work, which could offset some of any additional layoffs that occur from companies that no longer have access to PPP money. So we have multiple factors going in both directions, and both are going to be important to watch. Of course, we might see some additional targeted fiscal stimulus from Congress that could affect some of that may be more targeted. And then the final factor to look at, which is why I see August as really a reckoning, in addition to these federal unemployment insurance benefits expiring, is the start of the fall semester. And this is going to be another period of transition, I think, for businesses and for individuals as students, particularly K through 12, look to see whether they're going back to school. What does that school environment look like? And to the extent that they're not going back to school, how do parents respond to that? And how does that affect worker productivity, particularly given the fact that we still see a significant number of childcare facilities that are still shut down and not operational at this point. So I think we have another significant transition to go through when we go into August and the fall semester really begins. So just wrapping up then, the bottom line in terms of where we are, a couple of final points. As we go back to what we mentioned before, the primary factors here influencing the economic recovery are the medical community and the consumer. So those are the two major variables overall that we want to keep our eye on. I think bankruptcy rates as a statistic is the most important one to look to assess what the pace of recovery is likely to be in the second half of the year for the reasons that we mentioned before. And then in terms of a forecast itself, what are we looking at in terms of a slow and steady recovery? When again, that's a vague term. Can we put some specific numbers on that? And basically what I would suggest is that recall that we were at 3.2% unemployment in South Carolina back in March. We're at 12.5% today. And I would say that if we can get back to single digit unemployment by December of 2020, by the end of this year in the 8 to 9% range, I'd say that would be a success story for South Carolina. And in the absence of a widespread treatment, I'd say that's probably about the best that we can expect based on the data that we have available right now. So that is a general sense of where we see things going and what we mean by a slow and steady recovery. Again, moving unemployment, generally speaking, in the right direction and hopefully getting to between 8 and 9% this year. And then finally, the bottom bullet there, which is one of the most important, everything that we've talked about really does assume that we don't see any treatment successfully implemented in 2020. If we do, of course, all bets are off. Things can change very quickly. So it's important to keep that in mind as well as we're looking ahead. So I will stop there. Thank you very much for your attention this afternoon. And I'm going to turn it over to Mike Switzer now and stop sharing my screen. And then we'll go into some Q&A.
Okay, good job there, Joey, as always. Look forward to your presentations all the time. Okay, so we've got a few questions here. And I'm gonna save the first one here until last, but because I want to go right to some of the things that you said. You mentioned the bankruptcy rate being really important to keep an eye on. I don't remember if you said what it is right now. What is the bankruptcy rate right now, and at what level would you call it a tipping point? Maybe two different levels: a tipping point to the bad or a tipping point to the good, based on where we are right now.
Sure. So great question. I think, well, right now, first of all, we're seeing bankruptcy rates that are approximately at the level that they were at in 2019 year to date through May. So no real uptick overall in bankruptcies. Now, having said that, we see in the news that we've seen a lot of larger companies that have gone bankrupt and are going through some mergers and some other problems. But in general, particularly when you get down to small businesses, there hasn't been a sizable uptick yet when we compare the rate in 2020 to 2019. I think once that happens, if we see a consistent movement in that direction, where we see a consistent elevation above levels that we saw in 2019 or over the last several years, that would indicate more of a problem. So that's really what we're looking at this point. Do we see that increase in July, August, and September as these PPP dollars are used up, which are really masking a lot of the problems that businesses are having right now?
And then corporate spending right now has got to be skewed towards, instead of a normal economic growth period, skewed towards, okay, what are the things we need to invest in and equipment and planning and so forth to avoid a a debacle from the next pandemic. You know, what can we do to make our company safer when the next one comes along, now that everybody knows these things are out there?
Mhm.
And so do you expect that there would be a shift in corporate spending that would affect the economy?
Yes, I think that it does have the potential to impact productivity. I think businesses are going to have to be proactive and particularly in the short run, making their customers feel safe and engaging in processes and investments, whatever that looks like. It depends on the industry, of course, but creating an environment where customers feel safe doing business with them. I think that's their top priority. They have every incentive to do this because they want to get demand back to normal as quickly as they can. And I think as we move ahead, that does mean higher costs overall. We've seen the Federal Reserve talk about this as an element of recovery and as an additional cost burden on companies going forward. So I think it's a significant effect, or it has the potential to have a significant effect, but particularly in the short run, again, that's really one of the top priorities that companies have right now, just being able to get their demand back and making customers and clients feel safe is really the best way to do that at this point.
And then can we talk about maybe some specific sectors that we're expecting that would have, you know, major shakeouts regardless of what happens with, you know, this pandemic going forward? It seems to me like the restaurant and bar industry is just going to have a shakeout regardless. And then you've got what was I thinking of?
Well, I'd say
well, let's just go right to the one that I haven't heard anybody mention very much anyway, and that's the commercial real estate business.
Yes.
You know, retail's probably going to have a shakeout. You've got all these corporations who are realizing they've got productive workers that can work from home, so they don't maybe need all this space. So these things could have cause a lingering effect from this pandemic even after vaccinations are everywhere.
Absolutely, yes, and we're already seeing that. So going back to restaurants first, I think yes, they're gonna see a shift in terms of some restaurants will survive, others won't. But restaurants in general are going to come back eventually. But yes, the commercial real estate market is seeing some major long run shifts right now. And if we look in some of the major cities right now, population trends are already changing. We see more and more movement away from the major cities, from New York and San Francisco and others. We're already seeing rent costs that are being affected simply because there's not as much demand, because now people are recognizing that, as you mentioned, since they can work from home, there's not as much of a reason to be in these large cities that have a high cost of living. So commercial real estate is really going to be having to transition. And if you think about some companies as an example, think about Google, where they have these large campuses out in Washington State and in California, where workers typically are able to get free meals there, and they're able to exercise there, and they get a lot of perks being on the Google campus. Now all of that, whether that space is needed anymore is thrown up into question. And that's obviously just one example, but I think from an empirical perspective, actually looking at the data, we're already seeing people beginning to move away from cities, that real estate markets in terms of real estate pricing that's already being affected. And so as these workers are responding to the ability to work from home, companies are going to have to adjust. So it's a real phenomenon, and it is going to have a long-term impact.
And it might have a positive effect on our state, being that we are a small state, not heavily populated.
I think it will. We really have an opportunity here, because all the competitive advantages that South Carolina had going into this pandemic, none of those are going away. So we're going to be just as competitive as we were before. Plus, as you mentioned, all of these additional benefits of, yes, all these employees that can work for companies around the United States live in South Carolina. We do have a lot of natural amenities. We do have a lower cost of living. So there are some real opportunities for South Carolina to capitalize on these markets. Workers can come here, they can earn a living, and they'll be spending their wages in South Carolina.
Okay, and so now we have to go to the elephant in the room, since you mentioned August being a pivotal month. college football. It's probably not going to happen from the latest that I've been reading from some of these experts. They're not seeing it. So that has a big economic impact. And what does that mean for our state in particular?
Well, for Columbia, as we talked about before, Columbia does have more of a public sector component in terms of its economic composition overall. So yes, football, but not just football. The university more generally has a sizable impact in the Midlands region, and that has the potential to be affected going forward. And it is going to make Columbia, it's going to be harder for Columbia to recover at the pace of the rest of the state. So if we look out 2, 3, 4 years, we see leisure and hospitality recovering, we see manufacturing recovering, and so I anticipate that we'll see Charleston and Greenville-Spartanburg really bounce back. We don't know exactly when, but as the pandemic abates in the coming months and in 2021, hopefully when we get a treatment or vaccine, those two regions are going to come back a lot faster. And Columbia, suffering from these budget cuts and suffering from, again, a lack of football revenue as well. Of course, that affects all the vendors, all the local restaurants, all the local businesses that support the university in Columbia can potentially be adversely affected as well. So I think Columbia is going to have to be especially proactive in order to rebound going into 2021 and 22 in a way that Greenville and Charleston may not have to be quite as concerned about.
And for anybody who's joined late, let me point out, remind you that if you have a question for Joey, please use the chat function at the bottom of the screen and send that question in, and we'll pass it along to him. So let's go now to another big event this year that's going to happen later after college football, and that is the election. Can you give us any guidance on economic effects that you expect from the election one way or the other this year?
Well, right now it's a little too early to tell. I think as we get into the fall, we'll have a clearer picture of the specific differences in the candidates in terms of what they see their role in terms of, or what they propose in terms of economic policy changes. Now, we can talk generally about some of the platforms of the parties, but we haven't heard a whole lot in terms of specifics yet. So I think it'll probably be the fall before we can really assess what that looks like. Right now, I think the next policy that we're looking to potentially come down the pipe is whether or not and how much additional stimulus we see as we move into August, and whether we can see a bill that is that can be passed that would continue to help support the struggling economy, particularly given that we're hearing more that they want it to be more targeted in certain areas of the economy that are struggling, rather than just repeating what we saw during the spring and summer months. So I think from a policy standpoint, that's really the next measure on the table that we have to get passed. And then we need to see what the Federal Reserve decides to do as we move forward as well, because they're also open to additional stimulus. That because Jay Powell, the chair of the Federal Reserve, has talked about that this is going to probably be a U-shaped recovery, which means we're going to be climbing out for a while.
Okay, so you mentioned the Federal Reserve. Really, what else can they do? Interest rates are practically at zero. What else can they do?
Well, that's why we're looking more at fiscal policy at this point, because you're right. There's not a whole lot more that we see them doing, and so fiscal policy, I think, in terms of if we look at additional stimulus, both in terms of we hear stimulus checks, an additional round of checks being as a possible second wave of stimulus. We see the payroll tax perhaps being alleviated or eliminated as an incentive to go back for employees to go back to work. We also see potential an extension of these federal unemployment insurance benefits, though I think that's less likely. So there's a lot on the table there, and also providing specific incentives for individuals to to spend or to participate in different markets, whether that's leisure and hospitality or travel or others. So there are a number of things on the table right now from a fiscal standpoint, because again, with monetary policy, you're right, there's not a whole lot more that we can see going forward this year.
Well, Joey, that's it for the questions. Thank you so much. Great information. Always enjoy it.
Well, thank you, Mike.
Back to Mark.
Well, thank you, Joey. Thank you, Mike. That was very informative. We're usually looking for a W for like the win, but I'm thinking we don't want the W in this case. I'm going for, I'll take it. I'll take the U. A V would be better, but I'll take the U. Very interesting. And I'm definitely going to be tuning into what's happening in August. I'm curious about that. So I just so this concludes this session, and this concludes actually the overall series. It's the last of the 11 sessions. We will be posting all this information on the Executive Education website. You can see that there anytime. You can also feel free to share these materials with anyone you please. You can put them on social media, whatever. We're hoping to get this information out to as many people as possible. I'd like to thank everybody for attending, and have a good rest of your afternoon. Thanks.